All right, welcome back. Up to this point, we've built the accounting equation, the chart of accounts, the rules of double entry. And if you haven't seen those videos, I'd highly recommend going back and watching those first. Now we answer the most important question. How do we actually record real life transactions? So on screen here, you're going to see the chart of accounts, and this is from part 3. And then we left off by showing sort of the journal entry tab and how to set up the journal entry framework. And we have our date, our description, our debit, and let me just make this a little bit bigger here for you. Debit account, the credit account, and the amount. So what we want to do here is we want to follow the rules. Every row is going to be equal to one transaction. One debit is always going to equal one credit, and these are always equal. Now, we're not going to use values here for the last column here. It says amount, but you could easily put in whatever the amount was for you. What we want to get used to is transaction analysis, basically identifying which account is being debited and which account is being credited according to the rules that were introduced in a prior video. The best way to do this is just to go through some core everyday transactions that many people have. So example number 1 is going to be earning salary and we receive the cash, okay? So we need to think about the different kinds of accounts that are being affected and what category those accounts fit in so that we know what increases those accounts and what decreases those accounts. So in the case of earning salary and cash received, we know that cash is going to be impacted, and we know that our salary revenue or our income is going to be impacted. Both of these are going to increase. So remember the rule that with assets, increases are with debits. So the first thing that we can record here is that our debit account is cash. And remember that with income accounts, a credit increases our income accounts. So we click here, we go down to salaries and wages, and those are the two accounts that are affected, okay? And again, you can put in whatever amount there that pertains to your scenario. Also, there would be a date when this transaction happened. And if it helps, you can put a description in here as well. All right, so let's look at a second example. You pay rent, okay? In the case of rent, rent is what? Rent is either an asset, a liability, an equity account, a income account or a revenue account, or an expense, okay? Rent is an expense. The rule states that expense accounts increase with debits. So we know that we're going to debit the rent expense account. So that's the first thing that we're going to select here. So we look for our rent expense. There it is. And then what's being credited? Well, the other account that's being affected is cash. You pay for your rent with cash. And so cash is going to be decreasing. Cash is an asset. Assets decrease with credits. So we're going to choose here cash, and our cash has dropped. All right, example number 3. You go out and you buy some groceries. What are the two accounts that are affected? Well, first we have to deal with the grocery expense. And of course, that's an expense. And it's an increase in that expense account. And expense account increase with debits. So we have to debit the grocery expense account. Go down here, find it, groceries. And how are we paying for this? We're paying for it with cash. And so cash is our credit. The fourth example is we pay with a credit card just any sort of expense here. Okay, so let's say that the expense that we're paying for is dining out. Okay, so we go out for dinner, we dine out. That's an expense, so we have to increase that expense account. And in this case, we're not paying for it with cash, we're paying for it with credit. And credit cards are either assets, no, liabilities, yes. So the credit card liability is going to increase. Because it's a liability, liabilities increase with credits. All right. All right, the next example is we need to now consider paying our credit card off. And if we've increased the credit card balance by a credit, then to decrease the value of the credit card, we would need to debit it. So that becomes the first part. And we just choose the credit card here. And again, if we're paying off the whole amount, then we would record the same amount that we're just, we would record whatever the smaller amount is. How are we making that payment? We're making that payment with cash. And so we would credit our cash account because we're making the payment on our credit card. Next example, example number 6. We're going to buy an asset. So we're buying a car and we're buying the car with cash. So because a car is an asset, we know that we have to debit the asset account for the car, which would be a vehicle, okay? And you could have named this anything in your chart of accounts. In this particular example, it's named vehicle. If you have multiple vehicles, you may have 2 different vehicles, then you would just choose that. You'd also, upon purchasing a new vehicle, you'd want to add that to the chart of accounts, which I believe we'll go through in a moment. So vehicle is an asset, assets increase with debits. We bought it with cash, and so our cash is going to decrease. Cash is an asset, it decreases with a credit. So we credit the cash account. Next, we take out a loan. Okay, when you take out a loan after you go into the bank and you sign all of the documents, what usually happens is your account is debited, right? Your bank account is debited. It doesn't have to be. You could get a load of cash that you could walk out of the bank with, or they would send you a bank draft with the amount. But either way, it hits your account first in cash, and then it would be converted into that draft. On the other hand, on the other side, there's a liability that's created because you owe the bank that amount. So the 2 accounts that are affected here, one is we're going to debit cash because cash is an asset and assets increase with debits. And the second is our loan. So a personal loan or auto loan. I think that this one is personal loan. Okay. So up to now, everything has involved cash or obvious movements. But remember, economic reality does not necessarily equal cash flow. So now we're going to bring in some of those more advanced but critical cases. So we're going to talk about accrued income first. So remember, accrued income is when you've earned the income, but you've not yet been paid. And these cases, if you're doing contract work for individuals, so you run your own business, then you may run into a scenario where you've done the work during, say, the end of the month, but you have not yet collected, and maybe you're going to collect at the beginning of the next month, hopefully. So this is the case where you've earned it, but you haven't received cash. When you perform the service, you basically have an account receivable that is created. So we click receivables. Receivables is an asset, and assets increase with debits. So the other side is the credit, okay? So if we think through this, we've performed the work, so we've earned the income, even though no cash has transitioned here or been transferred from the buyer to you, the seller of the services. We still have to make a record of the transaction. So what we do here is we go down to our income, and we can use the freelance income field here. So you've done some work and you want to include this as income. Okay, so that's when you earn it. When do you actually collect it, and what do you do? Well, when you collect the cash, obviously cash increases, and we know that assets increase with debits. So cash is going to be the debit side of it. But what do we credit? Well, if we receive the cash, then that's no longer a receivable. We've received it. So we have to reduce our receivables by the amount that we collected. It may be the full amount. It may be part of the amount. Maybe there's a payment plan set up. In either case, we want to credit the receivable because assets decrease with credits and the receivable is an asset. All right, example number 10, deferred unearned income. So this is the scenario where a customer pays you in advance, okay? So you get the cash, but you have not yet earned the revenue. Now, this one is a good example because I don't believe that I have this. No, I don't have it in my chart of accounts yet. So this will show you how to add one to the chart of accounts. So we receive the cash. So the cash increases, assets increase with debits. And so that's the account there. We need to create in our chart of accounts a new account, and that account is going to be called unearned revenue. So we go to our chart of accounts, and unearned revenue is a liability. We owe the work to someone. So that's going to be under the liabilities section. I'm just going to insert a row here. We're going to just name this one 2400 and unearned revenue, and it's a liability. Now, it's very important that we update our list. So we're going to select all of these accounts, and we can see here that because I inserted the row, it captured that unearned revenue. Okay. Now, if we go back to the journal, let's see to make sure that unearned revenue is in fact there, and it is. Okay, so it updated because I inserted the row. So we check that. Now we've received the cash from the customer. We've put it aside where we've made note that we owe this customer. So anytime that we owe something, it's a liability. And we owe them this work. All right, let's go back to the example. So now we're going to fast forward and do the other side of this particular transaction. Now we're going to say that we've earned the deferred income. So because we've earned it, we no longer owe it because we've done the work. So we have to debit the unearned revenue. Remember, a debit to a liability decreases the liability. So we're going to go to unearned revenue here. And then we're also going to credit, not cash. We already received the cash. Now we've actually earned it, so we can credit our freelance income. Okay. So far, so good. We've dealt with accrued income and deferred income. Example 12, we're going to deal with accrued expense. Now remember, this is one that we have accrued. So we've incurred the expense, but we have not yet paid it. Okay. So we have an expense, and that we can record because the expense was incurred, but we have to make note of something that we owe someone, and that's called a payable. Okay, so what do we debit? We're going to debit the expense account. Let's see here. Let's say that we're going to create an expense here. And we're going to call this renovation expense. Okay, so we're going to go to our chart of accounts. We're going to find the expense here. We're going to add, let's say right here, insert row above. We're going to call this 5,400 renovation expense. Okay, let's say some repairs that were done around the house. Okay, this is an expense. So we come back over to the journal, and now we can include that. So we come down here and we say renovation expense. Okay, and then we have to add a payable because we don't yet have that as an option for our liability. So come back over here to our liabilities. We're going to insert this above here. So 2,500 account payable liability. Okay, so we select this from our menu, account payable. So again, we're making a record that we've incurred the expense. We have not paid for it yet, but there will come a time that we pay for it, and that time is right now. So example 13 is, how do we adjust this once it comes time to make the payment? So again, the account payable was increased with a credit, liabilities increased with a credit. It's going to decrease with a debit. So we debit the accounts payable account for the amounts that we pay. And how do we pay? We pay with cash. So cash decreases with our credit. Example number 14, a prepaid expense. So in this example, we're going to pay insurance up front. We get a policy, and we're going to pay for this expense all up front. So remember, if we're paying for something, we're taking cash and we're buying something else that's going to give us future benefit, we're just converting the cash to another asset. In this case, the asset is called prepaid expense. So let's go into our accounts. Let's see if there's a prepaid insurance. There is not. So we go to our chart of accounts. We look at our assets, and we're going to add it right here above the credit card. We're going to name this one 1,500 prepaid insurance and an asset. So we come back over here. We choose prepaid insurance as the asset, and cash is what we use to pay for it. So we're just converting. And notice here that the fundamental accounting equation, assets equal liabilities plus equity, in this case, prepaid insurance is an asset. It goes up and cash goes down by an equal amount. So the accounting equation stays in balance. Okay, now let's say that we bought that in period 1, and we want to allocate at, let's say at the beginning we bought it, the beginning of the month, and at the end of the month we want to make our adjustment for our prepaid insurance. We need to actually record the expense, and we need to reduce the value of the asset by the same amount. Okay. So if we have a prepaid insurance expense, or just an insurance expense, then we could just select it. Of course, we do not. So we want to go back to the chart of accounts. We're going to add this as an expense. So where can we add it? Let's add it to 5,500. So insurance expense, and it is an expense. So an insurance expense, we find that one. You can even type this in, which when your list is getting long, it saves some time by doing that. And then we want to decrease the amount of the asset, which we do by crediting it. And this is the prepaid insurance asset. Okay. All right, so let's take a step back. Every entry you just saw, it uses the chart of accounts. Okay, this is why the chart of accounts is so important, because we're selecting it from that menu. It follows the double entry rules. For every debit, there's a credit, and it captures completely our economic reality. So you're now tracking your net worth and changes in your net worth. The changes in that net worth are the difference between the income that you receive and the expenses that you pay. And also that will impact the equity section, and assets and liabilities are changing as well. Right now, we're simply recording transactions, but they're still sitting in one place, and that's in our journal. The next question that we need to answer is, how do we track each account over time? And what I mean by that is, in our journal, cash has been affected here, 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 not there, here, here, and so on and so forth. And cash is one of the most frequently affected accounts. It would be nice if we could have a summary of everything that's going on in the cash account, everything that's going on in salaries and wages, et cetera, et cetera. And in fact, we do. And this is where we're going next in our next video, when we talk about ledger accounts, which are just groupings of all of these different transactions. You're no longer guessing where your money went. You're recording exactly what happened. And this is a big step into the next step, which is our ledger accounts, in creating those financial statements, which tell us about our performance and our financial position. If this has been helpful, make sure you hit that like button. It helps with reach and accessing more people to get this knowledge just like you've got, and subscribe to stay up to date with new content.